Okay, welcome to Framework 10. I'm going to pick up exactly where we left off on Framework number 9. I'm not going to review it, so um, we're just going to keep on going on. If you didn't watch Framework 9 to know what's going on here, then go watch Framework 9. Okay, so where we left off, okay, we had said, this is our balance sheet and this is our income statement, and we had defined the relationship between the category of account, what our normal balance is, and our debits and credits. And also there's a relationship between our balance sheet and income statement, and that's why every business has a balance sheet and an income statement for their required financial statements, but not necessarily all of the other ones. Those other ones are optional, but every business has the balance sheet and the income statement. And as we go through, you'll see why here. Okay. All right, so now let's make a journal entry here, and let's just say, I hope I have space here. Okay, let's just say that this is a brand new business, so all of our accounts have zero balances in them. Okay, I'm not going to go through listing the general ledger accounts in the chart of accounts. I'm just going to pick accounts as I see in need. So let's say I'm going to have someone's going to invest in the business, okay, and they're going to invest $10,000 in cash. Okay, well, that's going to be that for that journal entry, we're going to have a debit to cash for 10,000. Okay, by the way, for those who don't know, K represents the thousand. Okay, and we're going to have, let's call it a capital account, whatever the name is. Okay, a credit for 10,000. Okay, so that's our journal entry. We would make that in the journal, and then we would post them to our ledger accounts. Okay, and of course, that's going to affect the balances in the ledger accounts. So when I actually post that journal entry into the ledger accounts, here's what happens. I'm going to have an increase of 10,000 to my asset account. Why? Because cash is an asset. Okay, and we increase our assets. That's what the normal balance sign represents. What increases? Okay, we increase our assets on the debit side. Okay, so that's why we're making a debit to cash, because cash is an asset. It's something we own, right? And we're increasing it. Cash went from 0 to 10,000, so that's an increase. And so we do that on the debit side. Okay. The other half of the journal entry is a capital account. Okay, so we're going to put the 10,000 underneath the capital account. And when we think about it, that investment is, it's an investment in the business. That's why it's an equity account. And we increase equity accounts on the credit side. So that becomes a credit of 10,000. And that's why our journal entry, debits equaled our credits, debit of 10 to credit of 10. And when you look up here, you can see that we still have a debit of 10,000 and a credit of 10,000, so everything stays in balance. Now, notice that our accounting equation is still in balance. I mean, our assets equals a total of 10,000, and that equals 0 for liabilities, plus the 10,000 in equity, which is 10,000. So assets is equal to liabilities plus owner's equity. And our accounting equation is in balance. We want to keep our accounting equation in balance, right? But as you'll see from our next entry, that's not always possible, right? So let's say right up front, we're going to make a sale. And let's say the sale is for $3,000, okay? Well, we're going to receive cash and it's a cash sale. So we're going to receive cash in the amount of 3,000, to record the sale of whatever that widget is, a cuckoo clock or whatever it is. Okay. Well, we're going to go through the thought process again, and in a future framework, I'm actually going to have a framework on how to create journal entries when you don't know how. A lot of students, when they first get started, as I mentioned in one of the other frameworks, you have this chicken and egg kind of thing, where in order to be able to teach accounting, we have to give you the journal entries if we tried to explain how to do journal entries, the thought process behind it, everybody would get lost. So it's easier to just give the journal entry. And what ends up happening is the students start memorizing the journal entries instead of thinking through the thought process, so that when they get stuck or they come across a new entry, they don't know what to do. So we'll have a separate video on how to make journal entries, and a process that you can think through. But for right now, let's just take it for granted that we know that here's a cash sale, and it's for $3,000. Well, we look at it again, cash is an asset, right? And we increase our assets on the debit side. So that's an increase of 3,000. So now our balance is 13,000 underneath assets, okay? But when we look at the other half of the journal entry, our sale, okay, well, a sale is not an asset. We sold something, we don't own it. We sold something, we don't owe it to anybody, and it certainly didn't increase our equity, okay? I mean, it was a sale. So over here underneath revenues, right, we put the 3,000, okay? Now notice just what just happened. If we come back to our accounting equation, we have $13,000 in assets, 0 in liabilities, and $10,000 in equity. Okay, our accounting equation is out of balance. So in the beginning of the accounting period, our accounting equation is in balance, right? But as soon as we go into the accounting period and we make journal entries, and as soon as we have a journal entry that does not affect only our assets, liabilities, and equity, in other words, we use a revenue or an expense account, it throws our accounting equation out of balance. But our accounting equation should be in balance. So what will end up happening is, in just a little bit, I'll show you how we bring the accounting equation back into balance. But I wanted to point that out right at this moment in time, because that's where this relationship between the balance sheet and income statement comes in. Okay, so let's take one more entry here, and let's just say we decide we're going to pay rent. Okay, and let's say the rent is, say, $1,000. Okay, well, our cash is, we're going to give away our cash because we're paying it out, right, of 1,000. Right? So this is going to be our journal entry, but now we need to post it into our ledger accounts, and let's take a look at what this is. Okay, when we look at our cash, remember, we increased our cash. That's what the normal balance sign is. Cash is an asset. We're increasing it on the debit side. Well, we're not increasing our cash anymore. I mean, we had 13,000 and now we're paying out 1,000, right? So it's not an increase, that's a decrease. So to decrease our cash, well, what's the opposite of the increase? Well, that would be a credit, right? Okay, it's just the opposite. So when we take out our cash, we end up with 12,000 left, all right? But notice that's a credit. Now, you can go and you can say, okay, I can memorize everything, okay? In other words, over here, I could say, okay, for a liability, a decrease would be a debit, and for equity, a decrease would be a debit, and for our revenues, right, a decrease would be a debit, and for our expenses, a decrease would be a credit. You can memorize that, but why memorize it and cloudy up your mind when you could just use a little bit of a thinking process and save yourself all that additional aggravation? It keeps things so much cleaner, so much easier to do. So again, my cash is an asset. Well, is my cash going up or down? My cash is decreasing. Well, does that make it a debit or credit? Well, I know that I increase on the debit side, so that makes it a credit. So that's why over here, my journal entry has a credit to cash. And since debits have to equal credits, I have to put a debit somewhere else. Okay, well, where am I going to put it? Well, rent is not an asset. It's not something you own. You can say, yeah, rent is a liability because you owe it, but really you're not owing it because you are paying it out. It's not like a loan where you owe it into the future. It's you're paying for something right now in order to run the business. Okay, it isn't equity, and obviously it isn't a sale, so it has to be an expense. Okay, so if we know that our expense was 0 before and we just increased it to 1,000, okay, notice we increase, that's what the plus sign is, the normal balance, we increase on the debit side, okay? So we put 1,000 next in our expense account, and our journal entry is in balance, and we've posted a debit and we've posted a credit to our ledger accounts, okay? Now, again, the accounting equation is out of balance, right? Throughout the accounting period, you're going to have many, many, many more transactions, okay? And all during, you're going to put them all into your journal. You're going to post them to your ledger accounts, and the balances in those ledger accounts are going to be different, okay? And at the end of the accounting period, you're going to create a trial balance as of whatever the date is, at the end of the accounting period, all right? And when you look at that trial balance, you're going to have balances in your assets and balances in liability and balances in equity, and they're going to be out of balance. And you're also going to have balances in your revenue and expense accounts, okay? Now, this comes to, I had the point where we're doing the closing process, and you've heard me in the previous frameworks talking about an unadjusted trial balance, okay? When we start with beginning balances, we make journal entries, we post everything at the end of the accounting period, we create an unadjusted trial balance, and that's where we're at right now, okay? We look and say, okay, do we have to make any correcting entries or any adjusting entries? And if we do, we make them, and then we produce an adjusted trial balance, right? And the adjusted trial balance is what we use in order to create our financial statements. So let's take a look at what happens in our financial statements, okay? If you create your balance sheet, you see your accounting equation is out of balance, and that's no good. I mean, 12,000 does not equal 0 plus 10,000, okay? Our accounting equation has to be in balance, and therefore our balance sheet has to be in balance. But when we look at our income statement, we see that we have a $2,000 profit, okay? 3,000 less 1,000 is 2,000. But notice this 2,000 is a credit, okay? It's a credit. Oops, blue on it. It's a credit, okay? Why? We have a credit of 3,000 and a debit of 1,000. 3 minus 1 is 2, and since our credits are bigger than our debits, that makes it a $2,000 credit, okay? Now, at this point in time, we're going to create an income statement to show that for this accounting period, yeah, we had a profit of $2,000, right? But we have to go one step further, and we have to make what's called closing entries, okay? And what the closing entries do is it reduces the balance in these temporary accounts down to 0, okay? So that we can start the next accounting period afresh with new information. But this $2,000 has to go somewhere. And notice that it is a credit. When we make the closing entries, that's profit in our business. And remember, we're back to this here, what our net worth was, right? Assets less your liabilities equals your equity. Assets minus liabilities is equal to your equity or your net worth, okay? Well, that 2,000 in profit, is cash. In effect, it's an asset, or you can think of it from that perspective, because why? You made sales and you had this amount of profit. So what we do with the closing entries is we reduce the revenues and expense accounts down to 0, and in effect, we move this $2,000 up into our equity accounts or our capital account. So we move the $2,000 up into the equity, all right? And when we do that, okay, now our equity account has $12,000 in it, so it brings our accounting equation back in the balance. We have 12,000 is equal to 0 plus 12,000, and our accounting equation is in balance. And if you go back to one of the previous frameworks, you saw, or the last one you saw, or the one that had trial balances, you had seen where all of the assets had balances in the accounts, liabilities and equity had balances, but you saw that the revenue and expenses didn't have any, okay? Why? Because they were closed out to the equity account, all right? And that increased our capital account, and it brought the accounting equation back into balance so that now we can actually go and create our balance sheet. We had already created our income statement, okay, before we made the closing entries, right? Now, after we've made the closing entries, we can create our balance sheet, okay? And our balance sheet should be in balance. Now, we're at 15 minutes, and I do want to, those who know accounting are going to jump up and say, you create your balance sheet before you make your closing entries, okay? And yes, that is true. That's the way it should be done, all right? Because errors can creep in if you create your balance sheet after you make your closing entries, all right? But if everything is done right, in effect, it ends up being the same exact thing. And for the moment, it's easier for students that don't know accounting to understand how this relationship works and the process and how everything flows. When we go into other videos and into future lessons, I'll be pointing out in probably one specific video, what happens during this closing process. I think in the textbook it's chapter 3, and that's most likely where I'll put that information when I get there, to highlight the fact that, yeah, our balance sheet should be made before we make closing entries. But for right now, I just wanted you to see that this is the entire accounting process, and this is how the information flows. So now, when you move into your next accounting period, okay, all of this information, all of these balances now are zero, okay? This balance is zero and this balance is zero, okay? And we move forward. So if I had, more, if I have more, not if, I'm going to have more transactions. If I have a sale to cash, say for a sale for 5,000, whoops, 5,000, and that's a sale, right, for 5K, right? Well, I'm going to add 5K in cash here because cash as an asset increases on the debit side. That's why I'm debiting cash over here, and I'm going to increase my revenue over here for 5K, right? So my debits equal credits. Let's say I have another expense, I pay rent again. Notice I'm keeping this simple, right? Cash 1K, right? So I'm taking out 1K here in cash, so now my balance is 16,000, and my accounting equation is out of balance, right? 1K, which means now I have 4,000 in profit, which is a credit. And when I make my closing entries, right, I'm going to move it up here, and it's going to bring my equity to 16,000, and my accounting equation ends up being back in balance. That was two simple, shortened accounting periods, and that's just the same thing for the next one, for the next one, and for the next one. Okay, so that's it for this one. If you have any questions on any of this, feel free to telephone and speak with an instructor, and we'll try to help you understand. But pause the video, go back over it, take notes, whatever. This is not what you're finding in the book, and it's not well, the information, the concepts are presented in the book, but it's presented in a different manner. Okay, so hopefully this will, for those that struggle with that material, this brings things to light and easier to understand. Okay, so in my next video for the framework, I'm actually going to go into how to make journal entries when you don't know how to make one. Okay.